thank you everyone for making some time to come out. I know it takes some time out of your day, and Emma and I really appreciate it. For those of you who have not met me before or seen me speak, my name's Miles Stoudy. I'm the portfolio manager for the Global Value Fund, and I'm also lucky to serve on the board with Chris, Jeff and Jonathan. We also have with us here today the lovely Emma Davidson, and for those of you that don't know or are fooled by how much younger than me she looks, Emma and I are actually married. So it's a 2-for-1 deal, 2 for the price of 1 when you invest into GVF. The main theme Emma and I wanted to talk about today is one that I think will be very, very relevant for all of us, and that is at a time when Australian interest rates are now basically 0 or less than 1%, how do we go about investing and trying to earn a decent rate of return? Importantly, and this is something Emma's going to talk about and explain, importantly, without taking on more risk than we should be. Before we get into that, Emma and I will give a quick introduction into the Global Value Fund, who we are, what we do, and I'll say a few words about the big picture, what we're seeing and what the team and I are seeing in London. You know, we sit at the coalface every day with the markets, what markets are pricing in today, and what we think are 1 or 2 of the interesting second-page stories. And finally, like always, we're here to help. So if you have questions as we go, of course, don't be shy, or we can answer questions at the end. And of course, Emma and I will be hanging around at the end to chat to anyone that has some time. Just quickly on a high level of who we are, what we do, I always like to just pause and go through these slides. We run a very differentiated strategy. We're very different to most propositions out there. And the core skill set that we have is an ability to find unlock value from investments that are trading below asset backing. So we're not stock pickers. Instead, what we do is look for ways to invest into the market at a discount, ways we can buy $1 worth of assets for less than $1. And then the key part of our proposition is unlocking that value in a very active, hands-on manner. And what we're trying to do with our strategy is really provide investors with 2 sources of returns. So you get the returns from the underlying assets we've bought, all at a discount, and then hopefully, if we're true to label, you get this second source of return. So that being the unlocking of the discounts, buying these things below asset backing and unlocking that value. I always find this aspect a little bit amusing for most people. Finding cheap investments around the world, finding situations where you can buy $1 for less than $1 is actually not that hard. There are a lot of these trading around the world, a lot of value traps. And of course, the most important part of what we do is not finding these situations, but turning up in them with a skill set to unlock the value that we've found. And broadly, there's 2 ways we go about unlocking value in these propositions. The first way, which always gets the excitement and the blood rushing, is shareholder activism or shareholder advocacy. And the team and I have a long track record of doing that. When we're finding these situations where we can literally buy investments below their breakup value, typically something's gone wrong. There's been a failing in corporate governance or a failing in corporate, management strategy. And we'll come in, we have a lot of IP, we've been doing this for a long period of time. We'll engage with boards, managers, other shareholders, and especially at the beginning in a very constructive and collaborative way. As I was saying, we have a lot of IP in these situations and a lot of suggestions and, experience in how to unlock value in a collaborative way when we work with boards and other shareholders. And more often than not, that's actually successful. More often than not, we're able to find these deeply discounted situations, come in, provide advice, help with the shareholder register, help the board, and unlock value in a collaborative way. G'day, Billy.
Hi, Miles.
Too soft. No.
Just to interrupt you there,
Yeah.
sorry. You said the team and I.
Yes.
Could you just explain who the team and I
Yeah, of course. So the question was, the team and I, who else is with us in London? So it's a reasonably sized team for the amount of money we run. There's myself and James Dow and Robert Fairbairn. They came with me from my previous firm. I always joke that Rob, James and I are like an old married couple. We've been working together for 12 years now, solely focused on this strategy. So we've got a lot of skill set and a lot of IP we've built up for a long period of time. Emma's been working in the business directly for 3 years now, and she's wonderful at shareholder advocacy. She does a lot of work with me when we're talking in campaigns and trying to rally support. And then we have a middle office lady, Emma Beale, who's also a wonderful resource for us. So 5 full-time staff, and then we have a big infrastructure around this in terms of compliance and risk and those kind of functions. So I was saying, so we find these discounted situations around the world. We come in, we try and work in collaboration. Sadly, that's not always possible. And when that is the case, I always joke that I get quite religious. I fervently believe in shareholders being able to access the value that is theirs. And we've got a lot of experience in engaging in much more muscular forms of corporate activism and a long track record of delivering good outcomes for all stakeholders in these situations, not just our own investors, but all the stakeholders in these situations where we've had to engage in much more forceful shareholder activism. The second way we go about unlocking value is in the securities that we specialise in, where we have a lot of our IP, there's lots of liquidity events. So what we're able to do is take advantage of the small arbitrages and trading opportunities we find in the market. And if you're light on your feet and you're not trying to move too much money around, which is really our mantra and what we're trying to build the business to do, these are really exciting little arbitrages or ways to unlock value. So those are the sort of the two bits of arsenal we have when we find discounted situations and we're unlocking that value. The last thing to say is, Billy and I were saying, we're global investors. Team and I work in London. We've been doing this for a very long time now, and we invest all around the world. We do invest from time to time in Australia, but predominantly we're finding these cheap situations outside of Australia. Just to finish off on, how I see our proposition for shareholders, the stated aim of what we're doing at the Global Value Fund is to generate equity market-like returns over time, measured over time, but with a significantly lower risk profile than an investment in the share market. And I always think that this focus on capital preservation and risk management is something that really sets us apart. It has been a lonely path to tread for the last few years because we've been in this tremendous bull market where everyone sort of made money owning anything. And wheeling out a strategy that protects for the downside, and obviously you have to give a little bit of the upside away when you're worried about the downside the way we do, has been a bit lonely. Passionately believe over a full investment cycle with the ups and the downs, with a proper bear market as well as this bull market, we'll come out ahead. Emma and I always joke that we're the tortoise, not the hare. But anyway, that's the key part of the proposition, protecting for the downside. Now, I can talk about all sorts of fancy things that managers use to protect on the downside, but in truth, the way that we protect on the downside is that we just invest into lower risk assets. So there's no rocket science to that. We have a skill set of unlocking value from discounted asset situations, and we apply that skill set to a very diverse pool of different types of assets. So we have some investments in shares, which is a higher risk part of the investment universe, but we also have lots of investments in debt instruments, real estate assets, infrastructure assets. My personal favourite investments, often situations where you can find $1 worth of cash trading below $1. Those are my personal favourite ones. And that portfolio naturally just has a very low risk profile. Theoretically, it should also have a very low return profile. It should be quite a dull portfolio to invest into. And how we're able to spice it up a little bit is because we're buying all of these assets at a discount, and our second source of return is unlocking the value from those. So we have two sources of return on the upside, but only one source of risk on the downside. Now, the best test for any manager that stands up and says he runs a low-risk strategy is to throw a real-life market correction at the portfolio. Not that we ever wish for these things, but they obviously do happen through time. And we haven't had many of them in the last few years. We have had this tremendous bull market run for a very long time, but we did have a very nasty shakeout at the end of last year. The markets got worried that interest rates were rising faster than markets were comfortable with. And in the December quarter of last year, so for just about 2.5 months, we had probably the worst equity correction we've had in years. And we've got some graphs here that show that. So from peak to trough, global equities in Australian dollar terms fell by about 14%. I think more instructively for me, in thinking about the bull market and perhaps we're towards the end of the run, the sectors that have really been the market darling through the bull market, the FANG stocks, the high growth stocks, are the parts of the market that really sold off the heaviest. And you can see here that growth stocks, as measured by the S&P Growth Index, fell by 20%. And the FANG stocks, these are the Apples and the Googles, the technology stocks trading on these huge eye-watering valuations, they fell by 26%. In comparison, GVF fell by 4%, demonstrating the sort of downside protection we aim to achieve when we have a big shakeout in the market. We don't use a lot of hedging, so we're not saying that we won't be down, but instead we run with this low-risk strategy, investing into low-risk assets. And certainly through that last serious sell-off we had in the market, that was the kind of result that we would hope to achieve. I'll start with three, or Billy.
Could you just clarify the 4%?
Yeah.
Is that NTA share price?
Emma said I should put share price chart up because I was going to get asked that, and I've just been asked that. So that is the NTA, but the share price, which is probably the more important one, fell by 5.5%. So the share price fell a little bit more, but not dramatically more. And sorry. Same question. Okay. Oh God! All right. That's what happens when you overrule the boss. You get in trouble. All right. Anyway, so I mean that's the proposition. Hopefully a lot of protection on the downside, but with reasonable, medium to high returns on the upside. We've annualised at 10.5% since IPO with this downside protection. And on that, and I probably stole on a few of Emma's points, I'll hand over to Emma. Do you want to do it?
Okay, thanks, Miles, and thanks everyone for joining us today. We're really grateful for your time. Miles has just run through the differentiated strategy that we run at the Global Value Fund, but I thought I'd just spend a few minutes talking about how we structure things at the company to ensure that shareholders directly participate in the investment returns that we make. You can see here on this slide some of the key metrics around the company and some of the key people involved with the company. Since IPO, net of all fees, we've annualized at 10.5% per annum, and we've done that with a much lower risk profile than a traditional basket of equities. Probably one of the most important tools that we use at the Global Value Fund is that of paying out all of our investment returns to our shareholders by way of dividends. And since listing in 2014, we have paid out more than 35 cents in dividends and franking. You can see that there, over there. And also, as of the estimated yield on the company as of FY 2020 is 8.2%. And the other point worth mentioning, which someone brought up earlier, is we have just over 1 year in the profit reserve in terms of the current payout rate that we're running at. The dividends that we pay out, however, are only part of the total returns that shareholders receive. Obviously, the other large part of that is the share price of our company. And for reasons largely outside of our control, GVF's share price over the past year has been weaker than we would have liked and weaker than we believe is justified. The big challenge that the entire listed investment company market has had to face is the fallout from the Australian federal election and the highly charged debate around the franking credit system. Without getting drawn into the politics of it, the Labor Party's proposed changes to the franking credit system would have left many of those investors who traditionally invest into LICs worse off from a franking point of view. And as a result of this, in the run-up to the election, we saw a broad-based buyer's strike against listed investment companies. While this has started to unwind, unfortunately, there is still some way for us to go before we get back to where we were previously. While GVF has held up much better than the rest of the market, and especially against LICs of a similar size, we haven't been immune to this. And having previously been trading at a premium to asset backing, we're now trading at a 2 to 3% discount to asset backing. That compares to a sector average of around 10% or almost 12% for those that are smaller than 500 million. If interested, page 25 of the presentation has the last 5.5 years of discounts and premiums in the Australian LIC market. And you can see how GVF has compared in comparison. I'd say that LICs are wonderful corporate structures for long-term investors, and with the franking credit debate now behind us, we believe that the discounts will continue to unwind, especially on our side. Moving on to the next slide. Yes, please.
Can you explain how you work out the adjusted NTA return?
Yes.
And the share price? I just don't understand that.
Sure, please, Miles.
Yeah, sure.
Yeah,
So what we're trying to do, and this is one of the challenges with the LIC industry, is there isn't a standardised format across the industry. And Chris Cuff wrote a wonderful piece about how we might all end up that way recently, if you're interested. But what the 10.5% figure is what if you'd invested into a managed fund. So it basically is the NTA returns over time, adjusted for tax, because obviously we pay tax and we give it back to you. And there's a small adjustment for the fact that the options came in and diluted the NTA. But it is the equivalent of a managed fund return. So after all fees and expenses, what the returns from the fund has done. Now the share price return, there's lots of ways you can think about that, but basically, as long as the share price is close to the NTA, shareholders have had a similar return figure.
The share price return is separate.
Yeah, absolutely. Yes, it is.
So why? Explain your footnote.
Oh, yeah.
Which one? Oh, sorry, I'm ready.
Yeah, so that's just, so when we do these presentations, we have to put a share price in to calculate the yield, and we just set a point in time. So that yield was worked out as of the end of September.
We have a lot of compliance issues, and when we issue a presentation, we have to choose a date, and then that's the date that we set the entire presentation on. Otherwise, they think that we cherry pick. So it's always done before we get out to Australia, and it's hence why it's a little bit old. So sorry about that. The next slide shows the dividends that we've paid out and hopefully illustrates that consistency of dividend payout and that promise that we've made to pay out all of our investment returns. Essentially, we've paid out 8 cents a year in grossed up dividends since 2016. As well as the 35 cents in dividends and franking, we also, IPO shareholders also received an IPO option, which was valued at around 4 cents, which they could have sold in the market or alternatively converted into more shares and realized more value. So since IPO, investors have received more than 39 cents in dividends and option value. And on top of this, as I said, the profit reserve stands at 1 year. So we have that comfort of knowing we have the ability to pay in these volatile markets. And that about summarizes the company and where we stand today. I'll hand back over to Miles to talk about the big picture and what's going on with markets at the moment.
So I always make some time to talk a little bit about the big picture. I spend basically all my life glued to a Bloomberg screen without a lot of sunlight. And once a year, Emma wheels me out in front of investors and I have to work on speaking clearly and articulately and distill down all that information into a few short slides. So I'm going to have a go. But I enjoy sharing these things because I get a different perspective, obviously, from London as a big financial centre. And I often find that, especially retail investors, are never really... it's not articulated well to investors what's actually going on in the market and why. So just starting with the big picture and what's going on in the markets today, in essence, what financial markets in every asset class are trying to price in is we're in the middle of a big growth slowdown. So things have gotten a bit wobbly. Global growth has slowed very quickly. For those of you that heard me talk last year, you might remember that Emma and I were talking that we were worried that a growth slowdown was coming. And that has turned out to be true. I guess where we've been a bit dumbfounded is the market response to this has been quite different to what we thought it would be. But I'll talk about that in a moment. But where we are, we're in the middle of a big slowdown in economic growth. There are a few factors that are driving this, but by far the most important one is the brewing trade war between China and the US. Whatever you think of him, and I know we all have strong thoughts on him either way, Trump hasn't jumped to do a deal with China the way the markets thought he would. So if you rewind back to the beginning of this year, the clear consensus in the market was Donald Trump's got to fight an election in 2020. He doesn't want to wobble the economy, and he certainly doesn't want to risk his chances of getting re-elected. He will do, this trade war is going to end very quickly. They'll do a quick deal and come to some sort of high-level consensus. That hasn't happened, and instead Trump has pushed throughout the year to try, to materially change what we call a mercantile trading practices that China's been engaging in for some time, and he's escalated the conflict continually throughout the year. And I find it quite interesting now that markets and commentators get very excited about the idea of a phase 1 deal, without any notion of when phase 2, 3, or even the finality might actually happen. When you rewind back 6-12 months ago, market consensus was an entire deal would be done very quickly. Anyway, so that's probably been the biggest driver to what's hit global growth. Most economists think that the trade wars knocked a full percentage point off global growth rates around the world, and that's quite a big hit in the context that global growth is only sort of 3 to 4% in any one year. You can see in this bottom chart here global GDP growth over time, and you can see that this current year, 2019, is forecast to be the weakest year for growth on record since the financial crisis. One of the interesting factors of the trade war and the impacts of it is it has disproportionately impacted export-heavy countries like Germany and Japan especially. And you can see some of that in the chart on the top. So the chart on the top is the Purchasing Managers' Index, the PMIs. And this is one of the best economic tools that we have. We've had it for a very long period of time for forecasting future economic conditions. And it's a diffusion chart, which is a fancy way of saying the way to read this chart is anything over 50 indicates economies are expanding and times are good. And anything below 50 indicates that in the future, so in the next 6 to 12 months, it's likely or probable that we'll see some economic contraction. And you can see that chart doesn't paint a particularly, in aggregate, doesn't pertain to particularly a healthy picture. Things have really rollen off. And one country in particular that's probably worth drawing your eye to is Germany, which has really gone from going gangbusters 12 to 18 months ago to today. Germany's basically flirting with recession, and that has huge implications for the whole Eurozone. So that's what's going on. Global growth has slowed. Markets are trying to assess what that means for asset pricing. The response to this has been central banks around the world have fallen back on their own playbook. So central banks have been cutting interest rates and in some cases re-engaging in quantitative easing. Now, in looking forward and in trying to understand what markets are pricing in, it normally takes about 1 to 2 years for central bank policy actions to work their way into the real economy. So if you cut rates today, you engage in quantitative easing today, it probably takes 12 to 24 months for the impact of that to turn up in everyday, everyday lives. So the optimistic case would be central banks have done enough, and probably towards the second half of 2020, so in the year ahead, we'll start to see growth pick up again, things to rebound, and life go back to a more comfortable place. The less optimistic case, which markets are also trying to understand and worry about a little bit, is that central banks are behind the curve. They haven't done enough easing, or more worryingly, they can't do enough easing. And this is the beginning of a slide towards recession. Obviously, we don't know how next year or the year after is going to look, but markets are grappling with those competing factors at the moment. Global growth is slowing. Central banks are easing to try and protect that, and either they'll be successful or they'll lose the fight, or they'll be behind the curve. The response to this, especially in the market, is what's really surprised Emma and I, and it's a bit counterintuitive. And in essence, despite the fact that things are getting worse, the economy is getting bad, markets have rallied really strongly. And the basis for this is, and we'll talk about this a bit later, when you cut interest rates, especially in the short term, it boosts all asset prices. It boosts the price of debt, it boosts the price of infrastructure, and it also boosts the share market. So you get this one-time big sugar rush. And you can see that perhaps most clearly in the top chart. So what the top chart shows is global share markets, so that's the navy in the blue, and in the grey is company earnings estimates for the current year we're in, 2019. And what I think is really interesting and very stark is that for this year, the two have moved inversely. As global growth has slowed, as company earnings have gotten worse and worse and worse, share markets have rallied onto all-time highs. And this rather odd equation of essentially what's bad for the economy is good for the market can last a lot longer than you might think is warranted or is reasonable, so long as central banks have enough firepower to continue stimulating the economy, continuing to support things when they get a bit bad. It will continue to provide a very supportive backdrop for riskier asset classes, particularly the share market. But at some point, and this is probably my view more than economic theory, at some point, our belief is that equation has to end. So at some point, good becomes bad, has to run out of road, and either things get so bad that bad just becomes bad and the markets have to start worrying about a real recession, or the alternative, which is probably the more hopeful outcome, which is that the equation reverses and good starts to become bad. So if we start having some good news from the economy, if things start to turn around next year, what you're going to see after that is central banks looking to pause the rate cutting and maybe even start increasing interest rates again. And I think that would be a very troubling backdrop for asset classes, especially the share market. If you remember the big drawdown charts we showed a few slides ago, what that was predicated on, what equities and other asset classes sold off heavily on the basis from was that interest rates had started to go up again for the first time in a long time. And having lived on a low interest rate environment for a very long time, if we get to a pause or an increase in interest rates coming up, I think that'd be a very troubling backdrop for financial markets.
It was almost like the markets had a tantrum. They were like, the responsible thing to do is to increase interest rates. And so the market just completely...
Yes.
Had a two-year-old tantrum. Something we're very familiar with.
Yes, at the moment. Yeah.
Is that your expectation, interest rates to go up? Because most people I've heard speaking think the exact opposite.
Yeah. So I guess, in an economic sense, you don't necessarily need interest rates to go up. You just need the easing bias to end and maybe a pause bias or even a tightening bias. And we have actually seen that in the last few weeks as the data has gotten a little bit better. Interest rates have actually started to rise. 10-year yields in the US are nearly back through 2%. But I think that's probably the more optimistic scenario, that central banks are ahead of that. When they solve the equation, we're going to go back to where we were a year or two ago. But at a big picture level, and I know I've probably sounded a bit bleak for the last few years, it's not an optimistic position to be in. When central banks have interest rates at 1%, whether it's 75 basis points or 125 basis points, that is not a resounding vote of confidence in the longer-term outlook for your economy, the growth of your country, or the longer-term prospects for growth and employment and all the things that are important today.
Just on that previous slide,
Yeah.
With earnings heading downwards,
Yeah.
at what point does that, it's going to pull share prices back because the dividends are going to be more difficult to pay out of lower earnings?
Yeah.
100%.
So that's one of the weird things about lowering interest rates, because what happens is the market puts a higher price on earnings. So even if your earnings for your company fall down, but your interest rates are lower, the market gives it a higher price, which is why you get things rallying up. But it's very much a one-time hit. So either earnings have to plateau or hopefully start going up again, or if interest rates start to turn around, that equation works in reverse. It's a really strange phenomenon. But,
The response to Westpac's share price recently is interesting in that regard.
and they sold off quite heavily, didn't they?
Well, yeah, because the earnings fell. and the
exactly.
dividend fell and the share price went boom.
Yeah.
So it doesn't always, I mean, I agree totally
No,
with
no,
you
it's-
about the overall market response to interest rates. but
Yeah.
You do find these instances with particular companies whose earnings fall significantly that the share price will go with it.
The penny drops, yeah. I think, and I've probably said this for a few years now, I think we're not far away from a penny drops moment across asset classes. But, you know, markets do weird things, and we could certainly do this for a few more years yet without anything too unusual. Yeah. Next slide. And look, I know I was quite gloomy last year. Emma told me I had to be a little bit more upbeat this year.
And we have not succeeded.
But I tried.
He did
But,
not listen again.
I just wanted to reflect. I always like to sort of, the second page thing, the things that worry me as I go to bed at night. You know, if you look at the big picture, markets are rallying at the moment because we're getting easier money. There's more money getting pumped into the system, and I understand that equation and it makes sense. But in the scheme of things, and I think this is what we're trying to highlight here, and I think it's just worth thinking about, is there isn't actually that much further we can cut. Historically, the main tool that central banks use to stimulate an economy is to cut interest rates. You cut interest rates, you stimulate things, and it works its way through the system. But obviously, as interest rates start to approach zero, your ability to continue to cut rates starts to get really problematic, probably ends. A few economies, especially at the moment Japan and the Eurozone, are experimenting with negative interest rates, so literally charging investors to park money at the bank. But even that has a finite lower level. If CommBank started charging you 0.5% or a 4% to park your money with CommBank, very quickly you'd find people stop putting their money in the bank and they start hoarding cash. And that's terrible for an economy because instead of the money going into the bank and being lent out again, you get this big contraction in spending. And indeed, I've read a lot of articles and it's obviously true. You can go hire a Swiss vault for a certain amount of year, and you know at some point people are just going to stop putting their money in the Swiss bank and put cash in the Swiss vault. That point where falling interest rates start to do more harm than good is called the reversal rate by economists. And every economy reaches that reversal rate at a different point. And because, you know, these are economists, and I say this because I am an economist, but because these are economists coming up with these numbers, you know they're not right, but they're a best guess. But I think probably the most important, or the big picture interesting point to opine on is that whilst we don't know exactly where this reversal rate kicks in, we do know we're very close to it. What we have here is the economists' estimate for reversal rates across some of the key economies around the world. And I think the really instructive thing from this chart is not whether the reversal rate is 1% or 1.5%. It's that every recession we've had in a Western country for the last 20 years has required 5% of interest rate cuts to deal with the recession, to cushion the economy and to bring about growth. And clearly we've got nothing like 5% of cuts in the system if we need them in the future. Now, the implications of this are not that we're all doomed. I don't want to sound too dire, but I think, you know, by definition, central banks have unlimited firepower. So they can cut interest rates, and as we've seen offshore, they can do lots of other interesting things. But I think the main takeaway is that when the next recession comes, we're not going to be fighting it with interest rate cuts. We just don't have them. They're not there. So instead, we're going to be relying on these unconventional tools we've been reading a lot about, quantitative easing, direct lending from governments. And I think, and this gets onto the main theme that Emma and I wanted to talk about today, I think that what's really interesting in an Australian perspective is that Australia's now in that camp too. Interest rates have basically been cut almost as low as they can. And if we do have to deal with a recession here, these kinds of conversations about quantitative easing, unconventional tools are going to have to become part of the Australian mainstream for many years to come. And I don't know if Australia's really sat down and thought about that too hard. So that brings us on sort of a nice segue to what Emma and I wanted to spend most of today talking about. I mean, just to sort of frame my life as an Aussie living in London, I haven't had much to brag about in terms of my sporting teams for the last few years, sadly, but I have been able to win pretty much every pub debate in terms of how well Australia's been going relative to the rest of the world. The Australian economy, as much as we all might moan about things, has done a remarkably good job in avoiding the problems that most Western countries have had to deal with since the crisis, being inflation that's way too low, weak employment growth, and a weak employment picture. Unfortunately, that no longer seems to be the case. And the RBA has this year basically halved the cash interest rate, cut it 3 times from what was an already very low 1.5% to now just 0.75%. In fairness to the RBAs, I mean, the issues that they're dealing with, a lot of them are imported problems. So global growth, as we were saying, is slowing, and central banks around the world are cutting interest rates in response to that. But in the main, the reasons the RBA has had to cut rates almost as low as they can make for sadly familiar reading in most other developed countries, and that is inflation that is persistently too low, too much economic slack in the system, which is a fancy way of saying unemployment's a real problem. And that's all well and good, but I guess the main message is the implications from this are not academic. The problems that the RBA are grappling with have direct, profound implications to all of us. Their main policy tool to date has been cutting the interest rate, base interest rate here in Australia, and that has a direct influence or impact onto all of us. It directly influences the price of our mortgages. It directly impacts the level of return we get from our savings. It directly impacts the exchange rate, which is very important. And I guess maybe one of these second-order implications, which we talk about in a moment, is it directly impacts the value of all of our savings. So this now very tiny number here, the community as a whole has a very, very large stake in what's going on. It's not just an academic problem. It has very real-world implications. I thought I'd just quickly spend one slide on reflecting on how we got to this situation. Again, so I'm an economist by trade. I can't help myself with some of these things. But I also find it quite interesting as we go around Australia talking to people that there isn't a great understanding as how we've gotten to the situation we're in now. So just to sort of take a big picture view, Phil Lowe, RBA governor, has 2 big post-it notes on his computer. One is full employment. The other one is stable inflation. And in that regard, the RBA, their mandate, is quite different to most other economies. There's only one other major central bank that has a formal, what's called a dual mandate, meaning that the governor or the Reserve Bank has to target both full employment and inflation. Most other central banks around the world are just tasked with dealing with inflation. So the RBA, Phil Lowe, 2 post-it notes he has to deal with every morning. And they're both not looking terribly good. So, the headline unemployment rate in Australia, and I think this is what bamboozles a few people, has for a long time looked pretty decent. Unemployment's about 5%. It's been there for a long period of time. And that on its own doesn't sound too problematic. If you lift the lid and look into the data underneath, this picture is actually much more troubling than you might otherwise think. While unemployment, and when you look at the top chart here, unemployment is the navy line.
This is the unemployment line, this middle line.
That's very well done.
Looks good.
But the one that's really worrying the RBA is the lighter blue line, underemployment. And underemployment now is basically at its all-time high. And just to explain, underemployment, so what underemployment is, it represents those people that have some work, but not enough work, not as much as they need or want. So you think about like the hairdresser that can't get enough days at the salon, or sadly a factory worker who can't get enough shifts at the plant. They have some work, but not as much as they need to get by. And 20 years ago, this was basically a non-existent factor in the Australian labour market. But these days, especially with the advent of what they call the gig economy, so people working lots of short-term jobs or part-time contracts, it's become very much a defining feature of the Australian labour market. And the RBA are looking at this and they're seeing a real growing problem. And what they have to look at in aggregate is the combination of the two, which is the grey line on the top. And that's called the underutilisation rate. And what that means is basically it's the summation of everyone that can't find enough work or can't find work at all. And at 14% of the workforce, that's basically 1 in 7 people that can't find enough work. And that's a real problem. That's the RBA, Phil not living up to goal number 1 that he set every day at work. The second issue that the RBA is facing is one that all the central banks around the world are dealing with, and basically is almost a new disease for Western economies, and that's inflation that is persistently too low. And I won't go through all the economic points behind this, but basically inflation that is too low is basically as damaging and as worrying as inflation that is too high. In the 70s, we had this problem. We couldn't tackle runaway inflation. Today, we have inflation rates in most Western world rich economies that is dangerously low. And in truth, it's something that economists and bankers don't know how to deal with yet. I think the best example of that is probably, sadly, Europe. In 2015, the ECB, the European Central Bank, came out and said, look, inflation's really starting to worry us. It's getting far too low. We're going to start some radical tools with some radical approaches. And they began the quantitative easing program that's been around ever since then. Since they began quantitative easing in 2015, they've spent $3 trillion. So it's $3 trillion of new money created out of thin air, pumped into the economy to try and deal with inflation. And the net result of that 5 years on is that inflation is actually lower today than it was when they began that program. So central banks are really failing in their attempt to keep this problem under control. In fairness, the problem here in Australia is nowhere near as bad, but the RBA is consistently staying below its inflation target. It has basically been below inflation target for the last 5 years, and markets are expecting for at least 5 years into the future will be well below the 2 to 3% target band that the RBA is tasked with dealing with. So that's how we got here. RBA is fighting a fight that it's losing. Employment's there's too much excess capacity in the labour market, and inflation's dangerously low, and they can't seem to get ahead of it. That brings us to the challenge and the real issue that investors today have to face. Ultra low interest rates bring with them a whole host of unintended consequences, especially when you get into some of the unconventional tools like quantitative easing. One of the unintended consequences, or one of the issues that they bring about, is it directly inflates asset prices everywhere. So you cut interest rates, the value of houses goes up because debt's cheaper. The infrastructure assets go up because it's a fixed yield in a low interest rate environment. And it also directly flows through to the share market. You get this one-time sugar rush, asset prices get based up considerably higher. But the flip side to that is it means our expected returns going forward have to fall. There's no free lunch. So you get a big free kick now, but the expected returns from your investment portfolio have to fall. And we're going to talk about that a little bit and some of the consequences that it brings. But I think probably without trying to get drawn too much into the minutiae of how the relationship between returns and expected returns work, I just reflect on Shane Oliver wrote this really interesting piece about 2 or 3 months ago. And Shane Oliver is the chief economist at the AMP. I really enjoy reading his stuff. He's a very level-headed market economist. And I thought his example probably summarised the situation quite well. He was saying that 10 years ago, his diversified growth portfolio at the AMP, so this is the AMP's in-house growthy portfolio, was expected to earn about 10% a year.
And this is equities.
A basket of equities and other sort of high-risk assets. A basket of high-risk assets would have generated an annual return of 10% a year. You fast forward to today, 10 years on, and that same basket's expected to generate an annual return of 5.5% a year. So the same portfolio, but with half the expected return going forward. And I think the key point is, and Emma's going to say a few words on this in a moment, the key point is while the expected returns from these kinds of investments have basically halved, the risks haven't changed at all. You're not getting a lower risk proposition, you're getting the same amount of risk, but a lot less return for that risk you're taking on. And in truth, that's what the central banks are trying to do. They're trying to force money into the economy, they're trying to force us out of bank deposits, force us to invest into the share market to try and boost inflation, employment, and those sorts of things. But the equation as we face it is that expected returns have to have fallen considerably, but risks haven't changed commensurately. And on that note, I'm going to let Emma say a few words.
Okay, so as Miles has been saying, one of the truisms of investing is that as interest rates fall, so the asset prices go up, but also all of our expected returns have to fall as well. And generally, the only way to get around this equation is for us to take on greater levels of risk to get the same amount of return that we've been used to. With interest rates where they are, typically, this means that we have to consider looking at much higher risk options, okay? The problem is that as we approach the drawdown phase of investing, we're all told that we need to be reducing the amount of risk that we take on, not increasing it. So in that process, what we're considering is the lower risk options. And the lower risk options that are available to us are things like term deposits, which are probably untenable for the majority of us, but also then annuities is another option in terms of low risk options that we might be able to consider. 10 years ago, we could put money in a term deposit, we could get 6%. Inflation was running at around 3%, and so our real yield or our real rate of return was 3%. Today, if we put that same money in a term deposit, we'll get 1.3%. Inflation's running at that 1.5, so actually our real rate of return is negative, and that just is untenable for the majority of investors. Another low-risk option that many of us have historically considered is that of purchasing an annuity. An annuity is a financial product that will pay you an income regardless of what financial markets do. At the moment, with interest rates where they are, if you're a 66-year-old man and you purchase an annuity, they will pay you 2.5% of your investment. So, for example, if you've worked, saved really hard, and you've got, say, $1 million in your superannuation fund, which is a large sum of money and way above the average for the majority of people coming into retirement, the annuity will pay you $25,000 a year, which is almost laughable, considering that you could actually go on the age pension and get more than that with the entitlements. Not only that, but if you have the audacity to give the Grim Reaper a run for his money and live past the age of 80, they'll continue to pay you the $25,000 a year, but for the privilege, they'll keep the $1 million that you invested. So really, when faced with these sorts of low-risk options, it's no wonder that so many of us find ourselves either consciously or unconsciously moving out along the risk spectrum seeking higher returns. And in this sort of environment, the message that Miles and I are trying to communicate to our investors is that of being really vigilant with our expectations and having a clear-eyed understanding of the risks that we're taking on when we make different investments. One of the key behavioral finance biases that we're all prone to as human beings is the concept of expectation anchoring. Expectation anchoring is where we're used to receiving 6% on a term deposit. And so when our term deposit rolls off, we expect to get a similar rate of return, and we expect it to be reasonably risk-free. However, any sort of product that's offering a 6% return, especially a debt investment or a 6% yield in today's environment, has a vastly different risk profile to that of a term deposit. And I think it's just really important that we're vigilant with where we're putting our money and we don't get seduced into investing into investments that carry risks beyond what we can reasonably bear. At the heart of all of our investing, so we've talked about the challenge and we've talked about how difficult it is at this moment in time to balance that risk-return scenario. And at the heart of all the decisions that we make from an investing point of view is us as investors trying to balance the risk that we take with the reward or the return that we need. And, you know, I'd like to think that GVF offers one possible solution to this challenge that we're all faced with. The philosophy that we pursue at GVF is that of seeking medium to high returns, as Miles was saying, but doing so with a much, much lower risk profile. In essence, what we're looking to do is we're looking to bend the risk-return profile in favor of our clients. And I'm hoping that this graph illustrates our ability to do that. This graph shows the GVF participation in global share markets on the upside as well as on the downside. And what you can see is that since IPO, we have participated in 63% of the upside, but only participated in 40% of the downside. And over time, the ability to participate in a lot more of the upside than the downside has a really strong compounding component. So while you give up some of the upside by investing into those low-risk assets, we believe that over time, through a full cycle, a bull and a bear cycle, we will outperform global equity markets. Also on the slide, I've just included a few key metrics which really do illustrate our low-risk strategy. In terms of how we achieve that, Miles touched on that earlier, but I thought I'd just quickly summarize. we don't do anything fancy. We're not trying to be too clever for our own good. All we're doing is we're investing into a pool of assets that naturally would have a lower risk profile than equities. So while we do have some listed equity in our portfolio, just to mention that all of these assets that we purchase, we've done so at a discount. So we've purchased them at a discount to their asset backing. But we hold a diversified group of assets, and the fact that they are diversified and we hold a majority of them together, the fact that they are diversified in the way that they are means that they tend to not move in the same direction at the same time. And that's what gives us our low risk feature, so to speak. In addition to the asset class diversification that we run and that reduced similarity amongst the assets that we buy, we also have a diversified currency pool. So we don't try to be smart or clever with predicting what currencies are going to do. Rather, we feel that the market is efficient, and what we tend to do is hold currencies that largely reflect the global investable universe, with the exception being the Aussie dollar, which is not 30% of the global investable universe. But what we've done there is any sort of currencies that are slightly exotic, we hedge back into Australian dollars. And I'll couple that, if you guys don't mind, I'll couple these two pie charts. If you remember the assets and the currency, I'm going to couple them with a graph that I've included this year. And it's this graph. This is GVF's investment returns after all fees. And what it shows is this blue here is the assets that we've invested into.
The attribution of the return.
Attribution of our returns. So the first pie chart was those asset classes. And as you can see, over the 5.5 years, they really haven't done much. They are what we said. They're a low-risk pool of assets. In addition to that, the currency is the next set of returns. The currency wheel that I showed you earlier, that is what currencies have done for the investment portfolio. And then this line here, or this difference here, is us physically unlocking those discounts that we purchase those assets at. And that is how we keep the risk low, but we give you those 10.5% returns by unlocking the discounts of the assets that we've purchased. It's all very well talking about risk and being low risk, and every fund manager says that they protect your capital, but what we want to do is we actually want to illustrate that to you. So what this graph illustrates... Oh, yes, please, go ahead.
Just a question coming back to that asset allocation.
Yes. This one or the other one?
That one.
Yes?
Given the general understanding that asset allocation is one of the critical determinants of any portfolio, I'm curious to know, A, whether that has changed, that mix, and whether you plan to change it. And secondly, is that just the outcome of where you found investments, or is it actually reflects a plan mix?
Yeah, so it's a bit of both. So I guess the main driver for where we invest is where we find the most exciting opportunities. That's core one. But after that, we also have a strong philosophy on managing risk. So if we're finding a lot of really cheap equity situations and it's starting to get above what we have a tolerance for, we either have to set the targets really, really high. Occasionally, we might do a little bit of hedging. The return target's higher. But more generally, we'll just say we're full there and we'll look elsewhere to fill up the bucket to try and keep the risk down. I think it's very easy to get seduced into trying to get ahead of yourself, but we've always been quite determined to make sure the risk profile that we run with is in line with what we've talked to people about, which is sort of half of the risk of the market.
So you don't sit out with a plan and say, looking forward to change that asset mix?
It will move through time, but it won't move dramatically. So equities might get up to 40 or down to 30, debt the same. But
we produce these two pie charts in every monthly that we do. And to be perfectly honest, I've been watching them now for 3 years and they remain very balanced. They remain very kind of, like this. Yes, please. Oh, sorry. Sorry, don't worry, I'll come to you next. Go ahead.
You seem to have little or no exposure to Asia. Is there any reason for that?
So what's on the right is the currency exposures. But in the left, we do have exposure to Asia. Some of it will be equity, some of it will be debt. In terms of the currency, so I guess, as Emma was touching on, we have a belief that you focus on what you can do well. And what we can do well is find things that are trading cheap and get the cheapness out of them. We've never once pretended we can call what the currency markets are going to do. And I'm personally a bit sceptical of those that think they can. separate issue. So instead, what we do is we let the currencies of the fund reflect the global investable universe from Australia. It's a long way to answer your question. I promise I'll come to it. We reflect the global investable universe from Australia, which is a way of saying we don't hedge the currencies. We let them run as they are, with the one exception being the Australian dollar. And as an Australian dollar investor, obviously the lowest risk currency you can hold is Aussie dollars because you've got no risk there at all. So where we pick up more exotic currencies, which is typically the Asian currencies like renminbi, Vietnamese dong, some of those exotic currencies, we'll hedge them back into Australian dollars because it's just a safer, lower risk place to be.
Yeah.
Doesn't mean we're not investing in Asia. So there's a few more questions.
Sorry, you next, if you don't mind.
Yeah.
I was going to ask about the currency hedging, so you sort of answered that a bit.
Yeah.
So you'll hedge the exotic Asian currencies or some exotic currencies.
Yeah.
In general, you just leave it alone. You've got some euro, you've got some pounds, you've got some US dollars, and work on the basis it's sort of...
My view is that's the safest position to be in. So you as an Australian investor, you want to invest into offshore capital markets. And what we do is we say we're going to let the investments reflect those offshore capital markets. And over time, currencies move up and down. As long as you're not trying to dynamically change the currency mix, and that is just one factor in your returns, and over time, it shouldn't be an important factor. The more important factor, if you remember the attribution slide, should be finding things on the cheap, getting the cheapness out of them. There's other ways to run with currencies. One is you can hedge everything back into Australian dollars, which we could do, which is expensive and not really what investors asked us to do at the beginning. Or the other way, without being sceptical, I mean, everyone invests in a different way, but you can also try to actively manage the currencies. I think the Norwegian krone is going up and the Swedish krone is going down. That's not what we do, and we're very clear that that's not a skill set of ours, and I think it's a bit dangerous if you start getting sucked into things that you're not good at.
So what I'm getting at is
Yeah.
your attribution graph, I think that shows that about 1/3 of all the profit.
Absolutely, yeah, no, if you go back. Yeah, of course. So what happened when we launched the fund is in that very first year, the Australian dollar depreciated quite significantly. So if you see this period here, the Australian dollar depreciated very significantly, but since then it hasn't really done much at all. So we don't take any credit for that, but no manager should really. A lot of managers made a lot of money there. We started our strategy. It takes time to start unlocking value, turning the portfolio over, and over time, by now, the unlocking of the value, that's the excess return. So that's the proposition that we've added on top of what markets have done as well.
I also think that it can be misleading. Like in terms of the assets that you own, it would be very difficult to replicate these two parts of the attribution on your own. I mean, that's the whole key. Managing that currency profile and keeping that currency profile so that it represents the investable universe is in itself part of our proposition and part of what the team does really well, I think.
It's sort of connected to that, you're short an index of some sort, probably a couple.
So that's part
That's
of
hedging.
No, so occasionally, the main way we lower the risk is investing into lower risk assets. But occasionally, when we're finding a lot of equities to do, or a couple of situations we're very excited about, we can use some hedging tools. It's not a big part of what we do. I spent 10 years working at a hedge fund before we set up Staudy Capital, and we're very familiar and comfortable using these tools when we need to. But I guess that's a sort of a second order part of what we do. It lets us, when we're really excited about a situation, maybe own more of it than the natural diversification on its own would allow.
The only short positions that we would have is because we've found something that's exciting and we need to hedge out some of the risk. And our hedging is limited to 30%.
Yeah, but we never use anything like that. Yeah.
So something like the Elliston's Global Fund, which you were in, you hedge that, or is it?
So those propositions. We were a big investor in Elliston. We bought that at a very deep discount to NTA. They've recently announced a restructuring that should let all the discount out. As a template, if we owned a lot of that, if there was a big risk in the GVF portfolio, we might hedge some of the underlying stocks or some of the underlying equity market exposure. But it's not been big enough.
Same with AMP China, when we had the AMP China position, hedged out some of those Chinese stocks because, again, we didn't want to have that much exposure to Chinese equity.
But I don't talk about it too much because it's a second order part of what we do. The main way is just keeping a very diversified mix of assets. Yeah, there was two.
Question.
Yeah, I won't forget you. Yeah.
Just a general question. In terms of GVF, is it a listed investment company? Because I haven't seen definition as such. What is it?
Yes and no. We're a listed investment company. The ticker is GVF. and we trade on the ASX exchange here.
And another point, there was recently, I think on Saturday, article
Yes.
in the Financial Review about listed investment companies, some of the difficulties they experience, especially with very large discounts and high fees. So I just wanted to know, in terms of the kind of discount that it currently operates, you found, and
Yes.
also in terms of the fees, what are the fees and how they compare to others?
Of course. So as Emma was saying at the beginning, the whole market here has been really whacked by the federal election, some tax loss selling, and probably there was a bit of oversupply in the LIC market in Australia. And then we've had this problem now where there's a lot of very deep discounts. It's not right for shareholders and it's very tough. GVF, we pride ourselves on looking after our shareholders, looking after the discount, and we've been fortunate that whilst we've been affected, it hasn't been such an impact. And we were saying at the beginning that the discount for GVF is only about 2 or 3% now. So we were a couple of percent premium a year or so ago, and we're a couple of percent discount now. In terms of the fees, there's a base management fee of 1.5%. We run a very hands-on, labour-intensive and unique strategy, so that requires a performance fee. But when we set the fund up, we sat down and worked out a performance fee structure that we thought was very reasonable. And the best way to do that is to set a very high hurdle. So in simple terms, the hurdle for us is about 7 or 8% a year. And on a low-risk portfolio, that means we've really got to work hard to get over that. So it's a long way of saying to earn a performance fee, we also have a high watermark. So to earn a performance fee, we have to have made more money than we've ever made before. And on top of that, we've had to make about 7 or 8% in the current year that we're in. And then after that, we share in 15% of the upside.
And just the final question.
Yes.
In terms of numbers of investors, are your numbers of people investing in the fund increasing, or they're staying the same? Or
So that's Emma's job. But no, I mean, we started as a $50 million fund, and we're $160 million today. And we have about 3,500 shareholders, which has probably doubled over the last 2 years.
Yeah, it's double. But to be perfectly honest, the reason we come out every year is we actually come to see our existing shareholders. We really believe that, Miles and I are building a business here for our lifetimes, and we've had 3,500 shareholders now for a good couple of years, and it's the same. It's the same people.
Last year we
loyal.
increased with the capital raise. We probably
Yes,
increased a fair bit.
little bit. Yeah, we increased a little bit last year, but it's kind of the same kind of team.
Sorry.
The
Finally.
chart on
Yeah.
the disposition assets.
The pie charts.
Yeah.
Okay.
Showed the exposure to listed debt instruments.
Yeah.
Just a question on that. I assume that's debt funds rather than direct instruments, because it's considered by an undervalued bond on the margin.
So it's wonderful that you asked that, because my first case study is about buying an undervalued bond. But on the main, it is discounted credit funds around the world. And offshore, it's a real universe of opportunities, much broader than the ASX. So within that, we have some very low-risk government bonds, corporate lending, and higher-risk stuff as well. Mainly funds, yeah. I mean, the main place that we play around in, buying a dollar for less than $1 is other listed funds, for sure.
One of the simple ways to think about GVF, and it is a generalization, it's not always the case, but ultimately we are a listed investment company that goes around the world finding other listed investment companies trading at a
deep
discount.
discounts.
Yeah, so it tends to be fund managers who are managing debt funds. Okay, so I was talking about talk being cheap, and you can't keep talking about being low risk unless you can illustrate it. So this graph is every single down month that global equity markets have had since GVF IPO'd. And that's in the grey over here, the light grey, and then in the blue is how GVF has fared in comparison. Obviously, we do not have a perfect formula. There are always times where, especially when we're targeting those medium to high returns, but I'm hoping that on average, this graph will illustrate to you our ability to protect on the downside and the ability with those diversified assets to keep the profile of our fund low risk and one that really does deliver on protecting capital. And the last slide from me before we get into case studies, which Miles will be able to talk to you about, we've got a couple of interesting case studies. This is our win-loss ratio. So this is every single trade that the Global Value Fund has entered into in its life and the P&L that we made on each of those trades. And if we are going to achieve what it is that we've set out to achieve, i.e. bend the risk-return profile in the favor of our clients, then we should see a skewed payoff profile in our trades. And hopefully that's illustrated here. When trades work well for us, they have the ability to work really well. And when trades don't work so well for us, so far to date, they haven't massively hurt us. 85% of the trades that we've entered into have made money. 15% of them have either been a slight loss leader or a time value. But hopefully that graph gives you a sense of that added extra return that we add by extracting those discounts. Miles, I'll hand to you for a case study.
You're doing the whole moving around. I feel like I'm letting you.
Well, we didn't have a clicker.
Oh,
And
that was my job, wasn't it?
We were told in Toowoomba that the clicker that's what made the presentation.
Wow, okay.
So,
All right.
you know, I'm trying to be the moving clicker.
So I have two formal case studies I'll roll through just to sort of give you a flavour of the kinds of things that we do and the kinds of things we're doing at the moment. Things are very cheap in Australia at the moment, and we're investing a lot more in Australia than we have in the past. And I'm sure there'll be a few questions about some of the ones we don't have a formal case study on, but I'm more than happy to talk about some of our other investments. But just I particularly like this one because it's a bit different, and it shows how we use our skill set in a variety of different ways. Just to set the scene, I mean, one of the big themes in finance in recent years has been this big growth in alternative lending. So as interest rates are really low and banks are retrenching back from the market, you've had a whole plethora of new entrants come into the market. And what they do is they raise capital from shareholders and they go and make loans to small to medium companies directly. So in a way, they act like a small bank. The problem with a lot of these new lenders is they're not that well tested. And like any big theme or new phase in finance, you get a lot of successful outcomes, but you also get some guys that are in the market that don't really know what they're doing as well as they should and have maybe over-promised and under-deliver. And this is one of those examples. So this was a London-listed fund called Rangers. It raised a large amount of capital and started lending that to small to medium companies across the United States, so like a small bank. It is analogous to a lot of the products that we're seeing listed on the ASX today. So in a zero interest rate environment, people are desperate for yield, and you get the bankers and the managers turning up with products that hope to fill that gap. But the reality is, obviously, as Emma was saying, you can't make loans 500, 600, 700 basis points above the base rate and not expect some of them to go bad.
It's taking advantage of that expectation anchoring. Your term deposit that you took out 5-6 years ago is running off. You've been used to getting your 3%, 4%, 5%, and you want something to roll into. And so a product is created that will give you that and make you feel like you're getting the same returns, but unfortunately the risk has dramatically changed in the time.
Changed, yeah. So that's exactly the summary. And that's what happened with this situation. So a number of the loans started to go bad. Not a lot of them, maybe 5 to 10% of the loan book became impaired in a very short period of time. But because you have an investor base that wasn't expecting any sort of impairment, that thought of these things as much safer than they really were, you had a dramatic impact on the share price of the company. So that's when we turned up. The share price had sold off very heavily. Our proposition was we could buy this portfolio of loans at 70 cents in the dollar, a big 30% discount to asset backing. Now, the team and I did a huge amount of due diligence on this loan book, and it's quite a complicated loan book. And at the end of that, where we decided as a team was, well, we think the company's cheap, but we don't think it's quite cheap enough for the risks that are involved. We know we understand the loans, but there's certainly some problem areas, and we don't think the equity makes sense. What we did instead, which is perhaps a little different than investing in the fund directly, was we bought the company's bonds. And offshore, it's actually quite a common feature of a lot of these vehicles. They'll issue bonds directly to get some term financing, not to worry about the bank. And we thought the bonds were much better value for a couple of reasons. One, they had tremendous coverage. So the asset coverage from the debt piece was about 3 to 4 times asset backing, which in simple terms means the portfolio of loans would have had to fall by 80% in value before the debt was impaired. So the debt was a very safe piece of debt. It had sold off very heavily in sympathy with the equity, and at the price we were buying the bonds, they were yielding about 5%. So on its own, that was not a bad investment. Buying something with a very low risk that's paying us a 5% coupon to sit there. What we loved, and where, in truth, I've had a lot of fun this year, was buried deep in the documentation for the bond prospectus. And I mean like page 273 of a 300-page bond prospectus was clear.
Which is very exciting for Miles.
Very exciting for me. Emma gets very frustrated with me, but I love this stuff. Clear legal language. And the legal language said, in the event that this company goes into liquidation, the debt is going to get repaid in full immediately. On top of that, as a penalty, you get paid the next 5 years' worth of interest straight away. So to put that in context, we were paying about £1 for the bonds. And under a liquidation scenario, our reading of the legal documents was we were owed £1.28. And we're getting paid 5% a year to sit there. I won't go through the whole gory detail, but our assessment was the company was going to go into liquidation. In fact, we helped it go into liquidation. And we've written a few public letters. There's a link to one of them if you'd like to read. What happened was a bunch of US hedge funds turned up on the register. The chief protagonist was the big famous Oaktree. They fired the board, they put their own chairman in, and they very quickly put the fund into liquidation. And the day after they called the liquidation vote that was passed, they got a phone call from me saying, have you read page 273 of the prospectus? I think we need to sit down and have a chat. They carried on like children for a few months, but we went through basically a 9-month negotiation period, which ended in June and resulted in them buying us out at £1.22. We took a small discount to get the deal done quickly. The icing on the cake, which I thoroughly enjoyed, was they also paid all of our legal costs as part of the outcome. So, a wonderful opportunity. And why I wanted to put it is sort of the unique things that we ferret out around the world. You know, as an investment proposition, a lot of downside protection. Obviously, wasn't no risk, but for the risk that we're involved with, we're getting paid a very attractive yield just to sit there. And then on top of that, we had all that optionality of unlocking value in the bond, which we did in this situation very successfully. So we made nearly a 10% return on something that was actually has a very low risk kind of underlying.
And I think this
feature.
example plays really well into the promise that we've made to investors that we're going to stay at a small size, 200 to 300 for GVF. Would it be fair to say, Miles, that in this scenario, if we'd been a bigger fund, we probably might not have picked up the bonds because it was just too much of a small trade. Whereas because we're small and nimble, we were able to actually say, you know what, we don't need to do an Oaktree and buy all the equity. We can go cherry pick some of those bonds.
100%. So a lot of these really exciting things we find are not scalable. We can't run $1 billion and have meaningful investments in situations like this. This is a small company with a small bond issue, with a lawyer that wrote legal documentation on the weekend. I don't know, but interesting propositions that we find.
That's hard.
Are there any formal questions? So we do have a little bit more time. I know we've taken a lot of time. Yes. Blue Sky.
How it's going? I mean, I presume you're on board, you're campaigning for winding up and that sort of thing.
We never get this question, that's why we have a slide.
So I'll have a good go at answering your question. We put a formal slide up because we knew we were going to get questions about it. I am on the board, so I have to be a bit careful with what I say. But just to, and the question was for the video was, a big investment for the Global Value Fund is an investment in BAF, Blue Sky Alternative Access Fund. It's a LIC here in Australia. It's been associated with the Blue Sky Management franchise, which is, I'm sure a lot of you have seen, has been a really sorry affair. And the management company this year went into administration. So a lot of people unfortunately lost some money on that. When the management company went into administration, and indeed before that, at the end of last year, the LIC that they managed traded out to a really big, deep discount. GVF turned up, we bought a very large stake, wider than a 30% discount to asset backing, and that's sort of the setting of the scene for the question. I'll just quickly run through the history. So at the end of last year, this proposition, trading at a very deep discount to asset backing, there was obviously some concerns in the market about the valuations, which is part of, I guess, what you're asking. My team and I did a huge amount of due diligence on the valuations, and whilst there were some parts we had some concerns about, in aggregate, we thought the shares were tremendously cheap. These two charts are updated for now, but the broad brush of the assessment still similar. And basically, you have a proposition today where the share price is trading 80 odd cents. But they're sitting on nearly 30 cents in cash. So that is obviously zero risk. On top of that, they have a big investment in a water fund, which has done tremendously well for sad reasons, being the drought. But more importantly, that was subject to a unsolicited bid from Chris Corrigan recently, and Peter Scallion. So again, there's another big chunk of the NAV that you've got a lot of confidence in. And what we're trying to show in this chart, and this was originally our thesis in investing into the fund, GVF effectively owns the rest of the assets when we bought them at sort of 25, 30 cents in the dollar. So tremendously cheap. Fast forward to this year, I feel a bit naive in hindsight saying this, but I mean, GVF had a big investment in this. We were very actively engaged with the board. I was probably spending 3 or 4 hours a week with all of the directors at the first part of this year, how to go about unlocking value. I got a real shock when the management company went into administration. And in hindsight, that probably sounds a bit naive. If you need to take a $50 million Mercy loan from Oaktree, same Oaktree, different parts of Oaktree, Oaktree again, a vulture fund, there's probably some structural problems in your business. But I think, in fairness, most people expected them to be able to manage that loan for longer than they did. That's not what happened, and the management company went into administration at the start of this year. So GVF has a large investment in this situation. I've certainly seen situations like this where value starts to get leached away, especially when you've got people like Oaktree involved in the equation. I rang the board. I've been speaking to the board a lot. I explained I had a very specific skill set in these sort of situations. And perhaps in fairness to the board, I mean, these are not directors that signed up to the kind of mess that they've been left with. I volunteered to come onto the board for no pay. I'm obviously a big investor, and my only incentive here is to make sure GVF does well. And that fast forwards to where we are today. I think there was an announcement put out by the company, BAF, about 2 weeks ago, which I heavily... 29th of October, which I heavily drafted, and you might remember these 2 charts were in that announcement. And I think what we were trying to say is as a board in that announcement was there's really 2 paths we can go here. 1, we can install a new manager to come in and revitalise the story, or 2, we can put it into liquidation. I think it's reasonable to deduce that the subtext of what's going on here is you have a big, aggressive firm like Oaktree who are not really that minded to put shareholders first, and not really BAF shareholders first, and don't have the sort of morals or fiduciary duty that other actors might have, and are trying to make sure the divorce is perhaps not as favourable as it should be for BAF shareholders.
Well, they're just fighting for their own side, right? And BAF needed somebody to fight for BAF.
Probably a good way to summarise it. So there's been a lot of robust discussions that have been going on for a few months, a few verbal punctures and whatnot. But I think what we were trying to communicate in that announcement was we're getting to the end of the road. There's 2 ways to go. We would like to come to a sensible divorce with Oaktree. You can't get sensible terms if you're not willing to walk away from the deal. And I think what we're trying to communicate is we're getting very close to deciding which way to jump. I don't know if that helps answer the question. There's a very long answer to the question. But from a GVF point of view, given how cheaply we own the assets, if we sadly have to go into liquidation, with me sitting on the board and GVF owning these assets at 30 cents on the dollar, GVF is going to do very well out of that proposition. I'm not going to let $1 of value disappear. And we own these things so cheap that taking it through the liquidation process would be fine for GVF. I personally think a new manager and a revitalising the story is the better way to go. Because a liquidation of this kind of proposition would be a very long affair. Because they're private equity assets, you're still going to be getting money back in 2022, 2025. And I think a lot of the shareholders would rather see the thing revitalised. But that can only be done if there's a sensible divorce on the table. And we're not going to sign up to any deal just to get a deal done.
Any other questions? Oh, yes, at the back?
Valuation portfolio, I guess not everything is listed. Firstly, what is listed there? Valued in price.
Everything, the vast majority.
Are you talking about BAF in particular?
GVF. Yeah, so pretty much everything starts listed. I'll say that. So yes, the vast majority of the portfolio is listed, and we just use market prices for that. It's very easy for the auditor. We do have some investments that are unlisted, and that's generally because we've been in a situation where something's gone into liquidation. And in those circumstances, we have to sit down. We have a formal pricing committee. We have to decide a reasonable value. And there's a lot of I don't get a say in what the valuation of these assets is. That's a very formal process.
Our compliance department has the say.
Has the final say, and then
Yes.
At the end of that, the auditor has to be comfortable with the values we're carrying these things at. But it is a very small part of GVF. I'd say it's probably only 2 or 3% of the NAV is in those kind of assets. Okay.
How much cash are you currently sitting on?
So it moves around. I mean, I think we're just working on the monthly now, which will come out in a day or 2 time, but we're basically fully invested. We have the ability to use 15% of NAV as leverage, and I always try and keep the portfolio working about 105, 110 if I can. Yeah.
Yes, please.
On Brexit and the British election.
Oh God, yeah. Okay.
We thought we escaped it.
How do you factor the various scenarios into your perspective?
Yeah. So Brexit and the British election, how do we factor those various scenarios into our election? I'm just repeating it for the camera. I'll start with the simple, boring bit first. So we have this mantra of risk is everything. You know, there's lots of exciting things around the world, and if we are in a situation where there's Brexit risk and there's a situation where there's no Brexit risk, we're just not going to own the Brexit risk. So that's a long way of saying we've basically de-invested a lot of the investments we've held in the UK, because whilst I desperately hope it doesn't happen, and in a probabilistic sense, it's a very low probability, there is obviously the risk that we have a very messy no-deal kind of outcome, and that would have a tremendously bad impact for asset prices. So from a GVF point of view, we don't have a lot of exposure. We have some, but we've had to set what we expect from these propositions to be much higher than average. I worry that you're trying to ask me what I think how Brexit's going to pan out, and I would just say, I was going to say that everyone's fed up with it in the UK, and hopefully we're getting close to an end. But from a pure selfish investment point of view, we've tried to steer away from anything that's related to that risk.
Maybe we'll wrap it up there. If you
One more. Oh, yeah.
One more?
Last one? Oh, two more. Last two, yep.
Alston, you mentioned
Yeah.
they rolled over rather quickly after Ashok Jacob.
Yeah.
Just last week, you had no intention of giving the money back. Do you have any input in that? I was speaking to David Kingston, he seems to be taking more.
You know, you should. So we own a large amount of that fund, but we never bought enough to start being involved. And we've been quite tied up in a few other propositions here in Australia, namely Blue Sky. We're disclosed on the Blue Sky register, the Fat Profits register, and the Monash registers, one where we have been quite involved. And we own a reasonable portion of Elliston as well, yeah.
Why do you think you rolled over so quick?
I think,
Reputation.
I think reputation is really important to a lot of these people, rightfully so. I mean, we have Mr. Lick in the back of the room just silently surveying the crowd.
Silently, like a ninja.
I think there's been a large rush of people into the Lick space, and a lot of them probably haven't signed up to the workload that goes with keeping a Lick trading at NAV and the shareholder engagement you need to, and sadly some of them haven't had quite the return. So, you know, for a manager that runs an unlisted fund that does basically the same thing, and then you have a Lick that does something similar, the threshold is very high to maintaining a discounted thing. And sorry,
I just came this morning from a rally, a SNAP rally outside Parliament House on climate change.
Yes.
I'm just wondering if you're exposed to climate change risks on a
From an investing point of
Yes,
view, or from an
investing
ESG point of view? So I can't say zero, because what we generally invest into is to other portfolios. But at an aggregate level, if there is risk there, it's very, very low. We're typically buying baskets of bonds and baskets of shares. We're certainly not taking big bets on oil companies or those kind of things. Yeah.
Thanks.
Yeah. Cool. Well, thanks everyone for making some time. We'll all be around. Thank you. At the end to